Welcome back to the Tradeciety YouTube channel. My name is Rolf. I am your host. I'm also the co-founder of Tradeciety, and I've been trading myself for over 15 years. And in this video, I have 3 moving average trading strategies for you that you can trade as a Forex trader, crypto trader. Also, if you trade commodities, stocks, indices, you can apply those principles. And they work across all the time frames. So whether you want to be a day trader or a swing trader, those tips and strategies will work for you. In the first part, I will introduce the 3 strategies and show you how to apply them on your charts. And then in the second part of this video, I show you how to set up your charts, how to adjust and use the right moving averages, and how to use the settings. The first strategy uses a moving average tunnel, and like most moving average strategies, this is a trend following trading strategy, because moving averages are best used in a trend following environment. So what we do is I activate 2 moving averages. Both have the 30 period. One is applied to the high, one to the low. Again, in the second part of this video, I'll show you how to set up your charts so that you can get the right moving averages. And what you then see is that you have this tunnel. The tunnel will never cross. Both are moving averages with the 30 periods. And what you can nicely see is that during trending periods, the market will typically stay on one side of the channel. So you can see in a downtrend, the market will typically stay below the moving average. In a sideways period, such as here, the market will sometimes trade around it, not make a significant effort to stay above the moving average, and then on the trend continuation, the market will fall back below the channel. And the great thing about using moving average as a tunnel is that they work perfectly as a trend filter. A lot of traders I have seen have huge problems letting winning trades run. And a lack of confidence is what often kicks traders out of good trades. The channel and the tunnel here help you to stay in winning trades for an extended period of time. If you see that the market is continuing in the trend direction, which is down, and is staying below the moving average, this can give you a lot of confidence. So you can use the moving average tunnel as some type of trend filter. As soon as the market then dips on the other side and breaks through the moving average channel, then this could be your clue to exit your trend following trade. And that way you can have a little bit more of an objective trade management filter in your charts. Before we continue with the video, I want to show you my new trading program. I call it the Tracademy. And this is the ultimate all-in-one trading education program. What you will find here is a completely new trading course. I've recorded over 80 videos with brand new trading content. The videos in this trading course have never been shared anywhere else before, and I go way deeper than in all of my YouTube videos. Also, you get mentored directly by me. I'm not using other teachers, I'm not using other coaches, I'm the one that you're always interacting with. There are live webinars taking place almost every week, and there's also a private community with other traders from all around the world. And also me, I'm interacting with all of my traders in the Tracademy directly and personally. So you join the new video course, you get personally mentored by me, you have new trading strategies, they are completely brand new strategies. I've never shared the videos before. They are for swing trading, day trading, and for all the time frames. There's a great and supportive community. It works for Forex, commodities, cryptos, and also indices. Everything that I've learned mentoring traders for the last 8 years and having been trading myself for over 15 years is included in this course. There's also a certification program. So after you've gone through the course and you have learned the material, there are 60 trading questions waiting for you where you can prove your knowledge and then at the end get certified. So if you're interested, make sure to check the video link in the description below. If you have any questions, leave a comment. And if you decide to enroll, I look forward to welcoming you in the Tracademy. The moving average length, whether you use the 30, the 20, the 40, some traders prefer to use longer moving average such as the 50. It really depends on the market that you're trading and the volatility level. So here you can see in this part of the trend, although for the most part the price went outside of the moving average, there were periods even during smaller or seemingly smaller pullbacks where the market almost broke the moving average channel. So in this case, the 30 would have been the right choice, but traders who would have used the 20 may have been kicked out by those pullbacks. this doesn't have to be necessarily a bad signal or a bad point, because you could have used then re-entry opportunities when the market made a new higher high, when the market broke out of the next consolidation. You could have used that as a re-entry filter. So there's no better or worse moving average setting. Some traders prefer the lower and the faster ones. Some traders prefer the slower ones. It really depends on your trading style. And then you can see here how nicely the market then traded higher in this channel, all above the moving average tunnel. And then when the moving average channel was broken to the downside, which happened here decisively with a huge breakout candle, this is where the overall trend shifted, and this is the part that we have already taken a look at. We have our first consolidation and then the continuation. So the moving average channel works really well for trends. Of course, in a range market, moving averages generally are not really useful since they are purely trend following trading tools. So make sure that you only use them during a trend following market. But when you're using them in trend following context, they work exceptionally well. For example, let's take a look at a recent market here. The market had here a trap pattern, a fake out. We have a lower bounce here. The market broke below the moving average, then trended lower here on the lower side of the moving average channel. When the market broke above the channel, we also had the retest. A lot of traders prefer to trade retests, then breakouts, and then you can see the market moved higher. We pulled back into the channel, then continued higher for an extended period of time. Here we had a little bit of a deeper push. The market did not advance into the higher trend as quickly, but the market traded around the moving average, which caused the price to briefly dip outside of the lower channel side. Then we have the continuation, and here when the market broke with strong force below the channel, that's when the overall trend also rolled over. So there's a huge difference between just trading around the moving average channel like here and an active break with strong bearish force. This is quite an important signal and an important distinction to make. Sometimes the market will just trade sideways without any strong force, and sometimes the market will actively break the moving average tunnel. This is a very different signal and something to keep an eye on. Then you can see we have a consolidation around the moving average channel, and then on the breakout the trend is continued. So the moving average channel is a great addition to your trading, especially if you lack confidence in letting trades run. This could be a great addition for your trend following trading strategies. Although you can use the moving average tunnel for trend pullbacks as well, what I really like to use is the EMA 50 period moving average. And this works exceptionally well during trending markets. So the market is starting out here with a strong bullish trend. Then we have the pullback into the moving average. The price is respecting the moving average, so we are not breaking below it too strongly, although there can be cases and instances where this is not a big deal. Then at the same time, we want to look for a horizontal pattern. Horizontal patterns are really great to use in your trading because they offer more objective entry points. And then when the price breaks above such a pattern as it did here, this could be your trend following entry. In such a case, what you typically do is, if you trade the breakout, you look for the breakout candle, and that's where you put your stop loss. So this large green candle is your breakout candle. You want to put your stop loss underneath it, and then you could write your trade until the market breaks the moving average, which would have been here. So let's see where this brings us and where this leaves us. This is a exit here, which gives us a 4-to-1 reward to risk ratio, which is pretty good in a trend following trading system. And then during the trade, you will have periods where the market dips into the moving average but doesn't break it. So here you can see the market touches the moving average really precisely. And this is a feature often when you're using the common moving averages. If you stick to the common ones, such as the 50, the 20, the 100, you will see that they work often exceptionally well. And you can use that as trend entry or re-entry opportunities. So again, we do the same thing. We look for the market touching the moving average. Then we look for some type of horizontal level that we can work with. And then here you can see we could have used this as a re-entry opportunity. You could also use this, of course, in a multi-time frame approach. So on the breakout, when the market breaks out, you could also drop to a lower time frame. Let's just see how this looks. So we go from 1 hour to, let's go to the 5 minute. And then here you could look for micro patterns. So this is the situation on the 5 minute on the breakout. You could wait for the market to clear this high. So this looks a little bit like a break and retest pattern, right? We are breaking above the previous resistance, testing it as support. And then on the breakout, when the market gets above this level, this is then where we look for entries. Such a multi-time frame approach will often give you much better reward to risk ratios, and that is because you can trade and really squeeze in your trade with a lower time frame price history. So you can see we could in this case just put our stop loss here underneath the breakout area. Because we are already trading on the 5 minute, there's no need to be super aggressive. So we could also put it just between the two levels, and that way you can see even if we go for a 3-to-1, this would be probably doable quite easily. You can see we have another retest here of the breakout area, and then the market shot into our target. And having this lower or multi-time frame approach, you can see we could have stretched our target much further. Of course, this is just one example. We could also choose to use the 5 minute 50 EMA in this case for our trend management. Let's just see how this would have played out. So when the market is breaking the moving average, in this case it's here. So you can see this would have given us a 5-to-1 reward to risk ratio when the market broke the moving average. Of course, there are ways to also improve or to adjust such a trade management approach on the lower time frames. For example, you could look for a divergence, which may have happened here. We could look for a trap, which happened here. So this multi-time frame approach can often help you to get in really decent reward to risk ratios. We are trading with the higher time frame. Keep in mind, we get our signal from the 1 hour. So this is a 1 hour trend continuation pullback. On the 1 hour, we have established that we are in a major uptrend. We look for those pullbacks, and then on the 5 minute, that's where we want to get in with our tight stop loss. And that allows us often, not always, nothing works 100%, to get a really high reward to risk ratio. Before we keep going, I just want to quickly let you know that I have started a free trading newsletter, which I'm sending out every Thursday. Every Thursday, you get a new email from me with trading tips, charts, and other very important tips that will help you improve your trading. As a thank you, I'm also sending you a free ebook after you have signed up for the newsletter. The link to that is in the video description and also in the comments below. And now back to the video. One of my favorite ways of using the moving average is as a general trend filter, and it provides so much information about the trend dynamics. So we are using the EMA 50, and this is the blue line, and what I want to see is trend information, break and retest, and especially changes in market structure. So what we are seeing here is we're breaking the trend line, the market is underneath the moving average, we're breaking here the low. We also see strong selling force. This is very important. Where is this coming from? After the market tried to break out, so we had a fake breakout, strong selling coming into the market, we have a lower bounce, and then a break of the trend line. So this overall looks like a start of a bearish push. So from that point on, we would start looking for bearish opportunities. We have a potential retest here. The market is retesting the moving average, which is a really great signal. A lot of traders, if you're aggressive, you're looking for shorts right here, maybe on the more lower time frame, or you wait for the market to make a lower low. In this case, you would wait for the market to break here the moving average, or the last low, not the moving average. We're already below the moving average. During a trending market, you can see the market pulls back into the moving average frequently. This is oil, so it could be a little bit more of a volatile market, but the principles apply in the same way. The market is really pulling away from the moving average, which is a very bearish signal. The further away the market is able to get from its moving average, the stronger the bearish force, or the stronger the trend force in general. Then we would just ride the trade and the trend as long as no opposite signal is given. We have here a triple bottom. You can see that very clearly. The market is breaking below it, but struggling a little bit. Now you can see the market is making a run into the moving average. We can put here our high. You can see equal highs. Now you can see we have something like a break and retest of the moving average. A little bit early because we are still here trading underneath the resistance. So we need to see a break and retest, maybe even a break and a dirty retest. We had made those dirty retest videos in the past where I talked about the liquidity trading Other traders will refer to this as smart money concepts, but it's all the same. So we're breaking above it. See, oil has a tendency to be very wild. So you could choose to wait for a dirty retest. So what we did is we broke the resistance here, right? So we made our first higher high here. As long as we still make higher lows, we are good. As long as the market is not able to close below this area, this could still serve as a bullish signal. Then liquidity traders, smart money concept traders would wait for the market to get above this and then look for long opportunities. This is also what we refer to as a 1, 2, 3 pattern. So if you've been reading or listening about smart money concepts, it's nothing but the classic old 1, 2, 3 pattern. Has been around for decades. There's no need to reinvent the wheel. It's a very common old concept used by many professional traders. And you can see the market is completing the 1, 2, 3 pattern. 1, 2, 3, we make higher lows, we keep making higher highs, we're above the moving average. Really, really nice market structure. This is a gap. Where's the gap gapping into? The price is gapping into the previous highs, pulled into such a big level, struggling a little bit. And now if the market breaks below the moving average, this would give us another bearish signal. We have a tight range here at the tops. We don't have an active break of the moving average, obviously. The market is just trading sideways, probably also a lot of uncertainty here after the gap. We see the continuation, great. Not really convincing though. You can see the market is immediately back here at the high. No active break of the moving average. Could be changing now. You can see that we're making lower highs. We're breaking below the moving average. This could look like a failed breakout as well. Let's just speed it up a little bit for the sake of this video. And you can see we're trading below the moving average. We're retesting it. And yeah, here's the gap open. Let's see, the market is below the moving average, which is generally a bearish signal. We have our retest, right? We've seen that in the beginning of this video. This is a pattern that is going to repeat itself over and over and over again. Move into the moving average. You could activate also your channel for pullback trading or for trend following trading, right? You can see how nicely this works. During the downtrend, the market stays below the channel. We have the dirty retest. We stay above the channel here. During the sideways range, you fall back into the channel. And that's it. Another way how I really like to use moving averages, and again I use the 50 EMA for this example and for this use case, is to just get an idea of trending phases. So when the market is in a sideways consolidation, you can see that this is the price action window, right? The market is moving back and forth and the moving average falls in the middle, which makes sense because keep in mind what we're using, a moving average. So this is the average of the price, and the average of a sideways range is usually somewhere in the middle. So that makes sense. And during a trending market, the moving average can really help us understand the trend dynamics. So clearly, the market broke out of this structure and then traded lower. You can see the market is pulling away from the moving average, which signals a strong downtrend. Then when you see that the market is coming closer to the moving average, so here you can see the market is narrowing and pulling into the moving average, this shows us the market is slowing down. Then we are trading around the moving average. However, this is what we are seeing here is very different from what we have seen previously, right? During the previous downtrend, the market pulled away quite a bit from the moving average. This shows us a lot of strength. Whereas what we see here is the market is staying really close to the moving average, which shows us not a lot of strength on the bullish side. So overall, we could say we had a strong bearish phase and a very weak bullish phase. And this could help us to estimate the likelihood of a trend continuation to the downside. And if we see then the market is continuing to the downside, this is then our impulsive phase. This is the corrective, very weak corrective phase, which is good. We want to find strength and weakness in the market. And the moving average and the moving average position helps us in this case a lot. We also have here a head and shoulders which we could have used. then you can see we get here our breakout into the trend direction, the overall trend direction. The market is not able to stay above the moving average, and this is then often, not always, signaling the next trend continuation phase. So we are now back into a trend impulsive phase. You can see how far the market is pulling away from the moving average, which is a very good bearish signal overall. Then you can see we have pullbacks. We trade around the moving average here. We are now seeing a change. The market is breaking above this area, so we are making a higher high. And we are also breaking above the moving average, which is a very big market shift. So from that point on, I would be very cautious to look for trend continuations in the short side. And I want to look for the signal and the information the market is now giving us. We are also testing here a previous support. So of course, the market could use that as a bounce to the downside, or if we get a break above it, this could be used to time a trade into the new bullish direction. We'll see. We don't have enough information yet. The moving average is right here at the price level. We're seeing a little bit more down movements. What we also see is that the market is kind of making higher lows here, which is an important feature. We're testing the previous highs. Looks like the market is making a run here. And now at this point, it looks way more bullish than bearish. We are breaking here previous support. Now it has been resistance, and now we are breaking above it. We're making higher lows. We're trading above the moving average. And all of those micro clues can be used together to form a good trade idea and to get a much better idea about the market. So I really like to use moving averages in that sense because they help us understand the trend momentum, how far is the price away from the moving average. Are we breaking above it? Are we staying below it? Are we pulling away from it? Or during a correction, we are not able to get away at all. Those are very, very important signals. Now you can see it looks really bullish overall. The market is above the moving average. We are pulling higher and we're pulling away from the moving average. Remember the previous example? Now what we could be doing is wait for the market to move into the moving average and then look for continuations. If you have missed the first breakout when the market changed the direction, now you could look for or wait for pullbacks into the moving average and then look for trend continuations with such an approach. So you can see the market is now pushing into the moving average, and at that point you could go also to a lower time frame. Remember, that's what we did. Now you can see it changed a little bit again. The market is breaking the moving average with a strong force, and now we have to see what the market is going to do. But overall, the moving average is a great help here. It really helps us understand the trending behavior, especially in a multi-time frame context. If the 2 hour, for example, this time frame is your higher time frame, you could use that information on the lower time frame then to look for trade opportunities into the direction that this time frame provides. This is a great filter and a great way to do a multi-time frame analysis. So it's actually quite simple in TradingView to set up your moving averages. You go to indicator as always, and then you can just type in MA and the moving average will pop up. And you can either choose between the SMA, simple moving average, which I used in this video for the tunnel, or the exponential moving average, which I used as the trend filter. So let's do the tunnel first. And for that, we just click twice on moving average, 1, 2. And you can already see at the top left, this is now giving us the MA, 9 period, SMA, and we have to change the settings. So we click on settings. And what we do is change the length. So I said you can use 20, 30, 50. And then we have to choose the source. So one is we're going to do it and apply to the high. This is going to be the upper boundary of the channel. I make it a little bit thicker here so it stands out. And now we have the 30 SMA and apply to the high. So this is one thing. Then I just click on OK. It's outside. Here you can see nothing is hiding here, SMA. And then we do the same for the lower part. We open the settings, we choose it to the same length, and this time we choose it to the low. This gives us the lower boundary of the channel. I just change it to thicker, and now we have the 30 to apply to the low, and you can see now this is giving us this channel. Of course, you can change the settings, the length of the channel, but this is what you have now. It's automatically applied to all of your time frames. And then regular moving average, you just type in EMA, and then you have a moving average exponential. It comes up as 9 periods by default. I just change it to 50. You can see this is now the EMA. You can choose to use smoothing as well, which I don't really typically use too much. I just leave it at the default. And now you have the 50 EMA on your time frame. A really great thing about TradingView is that you can very easily change the time frame. For example, we are on the 1 hour, and if we want to have the time frame from a higher time frame, we can choose here under settings, multi-time frame, and let's assume we want to have the 4-hour time frame. So we go to time frame and change it to 4 hour, and now you can see this is the 4-hour 50 period EMA on your time frame. And even if you go to the 5-minute time frame, it still stays as the 4-hour 50. So this way you can pull in a higher time frame right on your lower time frame. And this is all. It's not complicated, it's not rocket science, it's really easy to do that. And those moving averages will give you a lot of information, and they have many different use cases. So try it out and let me know what you think.